Today we're talking about the Australian private debt markets, and who better to talk to than the head of White & Partners, George Ajaka. And we're also going to go behind the scenes and talk to George about his role running the White family office. Hi George.
Hi Jeff, thanks for having me.
How are you finding the debt markets over the last 12 to 18 months? It's been quite a fast moving business. Has it become more competitive with a huge amount of inflow of capital coming from overseas?
Short answer, Jeff, is yes. It's a lot more competitive than when we first started doing this back in 2014 and 15, when there was probably a handful of players in the private debt space, which is no surprise as any arbitrage in any market, whether it's property, debt, equity, etc. As other players see an opportunity, they will then latch onto it. But to your point, it's not only foreign capital that's seeking that opportunity and pension funds, but it's also locally.
Yes.
It's the local fund managers, it's the local institutions and the local superannuation funds.
Can you tell us a little bit about some of the different types of deals that you're involved in at the moment?
Yeah, absolutely. So we both have what we call equity and debt investments.
Yes.
Debt's pretty straightforward. We act as a bank,
Yep.
Either first mortgage or second mortgage, where we come in and we fund land banks, residential development opportunities, greenfield pubs, industrial. We're not sector constrained.
Yes.
So for us, we look at, first of all, the property, the opportunity, do we like it? And as important, the borrower.
Yes.
And we view debt as really an opportunity for us to learn more about a potential partner,
Yes.
because ultimately there's always more opportunity in equity than there is in debt.
Yes.
So equity is debt's a nice dating opportunity, if you want to call it that,
Yes.
before we get married at the altar and we're into equity.
Yes. Yes.
So that's our debt book. Our debt book makes up 30 to 40% of our investments at any one time.
I see.
Our sweet spot is anywhere from 20 to 100 million.
Yes.
Equity is where we play in mostly.
Yes.
And again, we've got pubs where we own not only the freehold, but the actual business as well.
Yes.
We have industrial, we've got residential, we've got office, retail, all of them with partners.
Yes.
And our partners consists of both local, so Sydney guys, but also Brisbane based as
Yes.
well, because we have quite a significant portfolio in Brisbane. And the reason why we're in Brisbane is that we've got a healthy partner base who know
Yes.
what they're doing.
Yes.
As you know, Jeff, property is a local game,
Yes.
and so we need that local partner.
Can you tell us a little bit about the type of sort of debt deals that White & Partners has been involved in the recent sort of 12 to 18 months?
Yeah, absolutely. So, combination of things.
Yes.
Construction finance.
Yep.
In the residential space.
Yes.
Where the opportunity, that was an interesting one in Ashfield where we're up against the usual competitors.
Yes.
Ultimately, I think the reason why we won it wasn't because of pricing,
Yes.
but it was because of the way we actually viewed the deal.
Yeah.
We were very relaxed in our pre-sales.
Yeah.
I think once you ripped out all the FIRB sales, it was probably 40% pre-sale coverage.
Yeah.
The others didn't like that.
Yeah.
We thought, well, worst case, we're sitting on good property.
Yeah.
So, and we believe, in our data showed that particular area was doing very well,
Yeah.
and it was holding up well.
Yeah.
So hence why we're willing to back the developer with a very low amount of pre-sales.
Yes.
We went up to around 75% LVR on that deal.
Yes.
We've done land banks on retirement up to 80%.
Yes.
But again, the way we viewed that deal was how do we exit if things do go wrong?
Yes.
We had an alternative exit strategy.
Yes.
We've done retail centres in Bankstown.
Yep.
And even land banks here in Double Bay with SJD.
Yep.
So I think our competitive advantage, Jeff, in the debt space is I think borrowers like the idea that there's potentially we're able to do equity with them one day,
Yes.
but also the fact that we can see things through just being a financier.
Yes.
And I think it's fair to say a lot of our competition that is coming in, especially the newer competition, they are financiers, they're not property people.
Yes.
And so they are becoming a bit of a tick the box exercise.
Yeah.
So if there's a slightly hairy deal or a slightly unique deal, we can work through that because we
Yes.
are, first and foremost, we are property guys.
White & Partners are borrowers as well. How are you finding the banks? Is there is that loosening up a little bit in terms of their appetite for lending in construction and land?
Yes, but a little bit, not a lot. We haven't, from our perspective, we're probably a bit unique to sort of your typical developer. We haven't noticed a huge amount of change from the banks over the last 3-4 years.
Interest rates, pretty low, possibly going lower. What are your thoughts on that in the industry, and how does that sit and affect or impact your business?
Look, low interest rates are good for a short period of time.
Yes.
For us, it makes things probably more difficult than easier. Anyone who's got a yield on their asset now is asking a ridiculous sale yield for them to move that asset on, and it's understandable why. So I think, low interest rates is not necessarily a good thing. That said, it has seen retail mum and dad's conditions slightly improved, as our Ray data is showing. But I think for the long term, it's certainly not a healthy environment to have. I don't know if they're going to go up or down, Jeff. Every time I've guessed that, I've been wrong. So I just stay mute on that. But ultimately, I think a low interest rate environment for us makes purchasing assets probably more difficult now than ever before, in all honesty. And I think as an investment house, we would like to see interest rates go back to normal, that 3 to 5% mark. I think it reflects a stronger economy, and which will, result in sort of a justification of asset values for the long term. My biggest concern today is we sit in a low interest rate environment because the economy is not great, but yet asset values are very expensive. So how can you justify asset values moving forward when the 10-year bond curve is close to zero? So that is, I think, a concern that we have, and one that we're keeping in mind as we make investments.
What's got your interest? You can tell everyone your secrets and where you think all the best deals are going to be. But in all seriousness, what are you liking at the moment? What are you interested in?
Easier way for me to answer that, Jeff, is what we don't like.
Yes.
And there's not a lot that we don't like. And that is ultimately neighbourhood shopping centres for us, and shopping centres that are anchored by Woolies or Coles or IGA, whatever you call them.
Yes.
From our perspective, they're management intensive assets.
Yes.
The yields don't reflect, we believe, the risk associated with a lot of those tenants. I'm not talking about your anchor tenants, I'm talking about your mum and dad tenants. The rents, we don't understand how a tenant can actually afford those rents. And I think a lot of that market's been clouded by your institutions. Without mentioning names, I think they've just taken your traditional, we're going to whack on $800 a square metre net, we want 4% fixed reviews, and we want 10-year leases, for example. And I don't understand how you can lock a tenant in, especially a mum and dad tenant, over a 10-year horizon, and retail conditions fluctuating the way that they are, into some kind of financial arrangement like that. So for us, retail, traditional retail that is, supermarket retail style is something that we're staying clear of. Does that mean we're not putting retail into our mixed-use projects? Absolutely not. In fact, we are. We're probably focusing more around the entertainment and food aspect than fashion. So that's probably the only sector that we're very uncomfortable with. Asset values are expensive, Jeff. That is our view. It's been our view for a long time. That doesn't mean we're not doing deals, but I think we're just being smarter about the type of deals that we're doing. And also maybe sometimes instead of just being a pure equity partner, we'll take a structured equity position instead to sort of mitigate some of that risk, but at the same time giving away that upside to the partner.